All right, let's move on to the fourth section of the content. And let's start talking about multiples. So that's going to be lecture note 4, which is posted in the files lecture note folder on ELMS. So lecture 4 gets us into the fourth section, which is going to be talking about either comparables or comparables, depending on how you want to do that. But it's basically a multiple analysis based approach. And the idea of a multiple analysis is that when we do a DCF, we basically say, if we can figure out what the cash flows of the companies are going to be, we should figure out what the price should be, okay, kind of working forward. With multiples, you kind of work backwards. And with multiples, you say, okay, I know the price, all right? So what can understanding the price of the company tell me about its valuation? And it's a relative analysis, right? And so a good example of this in the real world is if you ever buy a house, okay? Because there's going to be an appraisal on that house. And the way that the appraisal is going to be done, it's a multiple analysis. What the appraiser is going to do is they're going to look for, in the last 6 months, similar type houses, and then look at the selling prices of all those houses. They're going to look at the square foot of every one of those houses that sold, and they're going to take the price divided by the square foot to get price per square foot, a multiple. And they're going to get an average for your area. So let's say your price to square foot multiple is, I'm just going to make up a number, $200. Okay. So if the average house is selling for $200 a square foot, then I want to appraise my house. Then what I say is, okay, my house has 2,000 square feet times 200 per square foot. It's worth $400,000. Okay. And that's the starting point of the appraisal. And then what they're going to do is they're going to say, okay, well, the average was 200. Do you have kind of the same features as the average? Well, then they're going to look at things like lot size. They're going to look at location. They're going to look at the age of the house, the conditions of the house. They're going to look at, for example, number of bedrooms. So for that 200 per square foot, if that's all 3-bedroom houses, you have a 4-bedroom house, well, you might get a little bit of a bump up. They're going to look at school districts. They're going to look at taxes, some other features. So they'll adjust up and down, but they're still going to use the relative values as a benchmark. Okay. Now, there's something called the law of one price that says multiples are just another way of valuing the same asset as the cash flows. And you can't get different answers. Like you technically got to get the same answer, right? And you can't, just because you change your methodology, it doesn't change the value of the company, right? So you're still going to get the same DCF. But the way I like to say this is that if you think of ROIC as a shortcut for free cash flow, multiples are the shortcut for free cash flow valuation. They're simple. Okay. If I take a multiple, price to earnings multiple, and I have $5 of EPS and my price to earnings is 10, and the share price is 50. And if I have $6 of EPS and the multiple is 10, then the share price would be 60. Right. So it's just a way of simplifying the DCF. Right. So the advantage to multiples is that they're simple and they're easy. The disadvantage to multiples is that they're simple and they're easy. They're overly simplistic because we're literally taking the entire value of the firm and basically pushing it down to one number, right? And so therefore, it's a broadsword. It's not a scalpel when we do valuations, right? But one of the reasons why bankers love them in the real world is because of lawyers. So let's say that you're advising a company on going public or doing an M&A or whatever they should pay. Well, when you get sued, all right, and you're on the witness stand, and somebody asks you, opposing counsel, how'd you come up with the value of the company? You say, well, here's my DCF, right? You're going to get crucified in every one of those single assumptions. If you say, how'd you value that company? I say, well, I actually looked at all these other companies that were publicly traded and I valued them based on actual data in the real world of market prices, then it's more defensible. Okay. So I think that's another reason why people like multiples, because DCFs are kind of like a theoretical value. Multiples are based on real world actual prices, right? It's kind of a relative valuation. So multiples look at market prices as a benchmark for valuation. They can actually be helpful to value private companies as well as public companies, because they can say, okay, if a public company that looks like this is trading at this value, then a private company that looks like this should probably be trading at a similar value, right? And one of the challenges with multiples, which we'll get into, is finding what is actually similar. It sounds simple, but it's actually not as easy as you think it is, okay? And obviously, current prices play a role and sensitivities. So back to the challenge. One of the biggest challenges of multiples is finding similar companies, right? And I'll give you a simple example. Let's say I'm trying to find a comparable to CVS. Rite Aid? Everybody agree Rite Aid would be a good comparable to CVS?
Yeah, that's what I just said.
Okay. But here's the thing. If you think about CVS, their stores are about a third of their business. Another third of their business is Aetna, the insurance company. Thank you. And another third of their business is essentially CVS was a Caremark, which is the drug distribution company. So they have three businesses, right? So when you look at CVS against a competitor like a Rite Aid that doesn't really have an insurance company, or Walgreens that doesn't have an insurance company, you're kind of comparing a little bit of an apple and an orange, right? Same thing. You're going to compare Aetna against Humana and maybe United Health Group, right? But United Health Group doesn't own a bunch of stores. Humana doesn't own a bunch of stores. So that's what I'm saying. Like when we do these comparables, they're not as easy as you think because companies actually do different things. So for example, a couple weeks ago, I was at a company called RTX, which was a merger between essentially a commercial company, United Technologies, which made aircraft engines and built parts for commercial airlines, and a defense business, okay, which makes like the HIMARS or the Patriot missile system, anti-missile defense. So defense companies, RTX measured against Lockheed Martin, Northrop Grumman, blah, blah, blah. But another half of RTX's business has nothing to do with Lockheed Martin because they're actually being compared to all of the commercial companies. And so, for example, Rolls-Royce jet engines as one example. So finding comparables can be a challenge. There's very few companies that actually do just one thing and their competitors just do one thing, okay? Like even if you think about cruise ships, you got Royal Caribbean against Carnival. That's actually a pretty good direct comparison, right? But Disney owns a cruise line. It's a pretty big cruise line. And when you compare Royal Caribbean against Disney, well, Disney's got theme parks, Disney's got a movie studio, Disney's got Disney Plus. They got a lot of stuff over there that has nothing to do with the cruise lines. So yet Disney is a competitor and peer of Royal Caribbean. So again, this just gets back to the challenge with multiples, is that what you end up having to do is that instead of just looking at purely the company, you want to try to look at companies of similar sizes and kind of similar growth rates and similar returns. That makes them more comparable, right? And just as another example, you don't want to compare a company like Meta with a social media startup, right? Because even though they might be doing social media, it's really a different business. They're going to have different growths, different levels of return. So ideally, you want to have companies with similar growth rates and similar levels of return when you're doing your true analysis, right? Again, not always easy to do, but that's actually the challenge with multiples. So the process for multiple analysis is pretty straightforward, right? First, find the companies, find the peers, preferably ones that have similar profiles. Two, once you've identified your peer group, then get your data. Your data is going to come from Bloomberg. Three, calculate all the data, calculate your market multiples based on the market current data. Again, that's going to come from Bloomberg. Then you kind of benchmark and try to understand the differences between the companies and then explain it. Best practices, already highlighted it. One, try to choose companies with similar prospects for ROIC and growth. Two, we've already started this. Forward multiples, not historical multiples. The book makes a big point of this, right? And the idea is that a company's worth the sum of its future cash flows. And so therefore, the forward multiples and the forward earnings that they're based on are more indicative of the future cash flows than the historical cash flows. So even though in the real world, a lot of people will use last year's PE, 12-month trailing PE, the professionals tend to look more at the forward multiples, okay? Because they give a better relation to the future cash flows. And that's why we started with the valuation. We're not using forward year one, okay? We started with forward year two, forward year three, because when you're doing multiple analysis, it's better to have 12 months of clean forecast. The multiples tend to get more normalized, right? I like to think of the current year, forward year one, as a dirty year. When you mix actual data and forecast data, you don't get as normalized a multiple. So again, McKinsey has shown that over time you get better multiples when you do multiples based on clean forecast years. That's why we started with the second and third year out in Bloomberg, and we didn't use the first year, the current year's multiple, even though it was a semi-forward multiple for our valuations. We also tend to prefer enterprise value multiples, right? And the reason why is enterprise value multiples tend to be more explainable than price to earnings multiples. Even though PE is probably the most ubiquitous multiple out there, and everybody's at least heard of it, it's actually the hardest multiple to explain, because price to earnings multiple is based on earnings per share, which means it's based on net income, okay? And so therefore, when you're explaining what's driving a PE ratio, you got to explain everything that goes in net income, which means it's not just the operating costs and the non-operating costs. You got to explain debt, capital structure, taxes, non-operating gains and losses, all affect PE, okay? And so, for example, the amount of interest has a big impact on PE, right? So you have two companies, they're identical. One has debt, the other doesn't have debt. Because the one has debt, it's going to have lower earnings. It's going to affect their multiple, right? Even if the values, the operations don't change. So we tend to prefer enterprise value multiples because they tend to mitigate some of the problems with capital structure and the one-time gains and losses. Think of it another way. If you stop at EBIT, then enterprise value to EBIT, you got to explain to EBIT, right? You don't have to explain everything below EBIT, right? Stop at EBITDA, EV to EBITDA, you don't explain usually everything below EBITDA, and it tends to be more normalized. When you got to go all the way down to net income, you got to deal with everything net income. And then for the kicker with net income, you got to deal with all the GAAP accounting weird stuff that's going on. So accounting can distort this. It can distort net income, and that can distort a PE. Enterprise value multiples, EBIT, EBITDA, less distorted by changes in the accounting rules. And so therefore, enterprise value multiples tend to be more preferred. Not saying we don't use PEs, but as simple as it is, actually is a pretty complicated multiple, and it could be the most distortable multiple. And then finally, and it gets back to adjustments. If you have two companies and they're identical in every way, and one company's got a ton of excess cash and the other does not, well, that's going to distort the multiple. So non-operating items can distort multiples, and we got to be aware of that. Okay. Now, we're not going to get too advanced in this class. We don't have time, but I at least want you to be aware of that when you're doing your multiple analysis. If you have questions about this, feel free to jump in. All right. There's also something called precedent transactions, right? That's M&A. And I'll give you an example of what I'm talking about. So another nice feature of the Bloomberg tool is you type in MA and it's got a mergers and acquisition database. And this is 32,000 deals around the world that have been recently announced or completed. So these are ones that happen to be done today. See any US companies did any acquisitions today. But who's been buying somebody recently? Who's a US company that bought somebody? Oh, but this way, I'm going to go a different way. I'm going to make one up. Eli Lilly. Just type in Eli Lilly. Here's a list of all of Lilly's publicly announced deals. So you put a company that's all their deals. So one of their more recent deals for $2.3 billion was to buy a company called Morphic Holdings, right? For $2.3 billion. So if I click on Morphic Holdings, it's a lot of information about the deal, down here, there's something called deal comps, right? And what this represents is Bloomberg will try and find M&As that are similar to companies that have bought a company like Morphic, right? Probably a small biotech or other early stage startup, right? Now, we don't have a lot of data on these companies, but these were the acquisitions. They go back to 2014, by the way. So not a huge amount of trading in this type of an industry, but nonetheless, these were all the purchase prices paid. And this was, if the companies had profits, 3 of them did, this would be the price paid to EBITDA, it's multiple. Price paid to EBIT as a multiple. Price paid to revenue, if they had revenue as a multiple. And so these are the industry averages. So for these early stage companies, people paid 60 times revenue. For these early stage companies, they paid about, well, 33 times EBIT, and 2, they paid 548 times EBITDA, which is another way of saying for early stage companies that don't have profit, you tend to value them based on revenue with the assumption they'll eventually make a profit and generate cash flow. But that's the idea of an analysis. So it's just saying that if I go in and offer Morphic Holdings, 20 times projected revenue, then that's pretty low compared to some of the prices we've paid in this industry on average. That's a couple that are in that lower range, but that's the idea of it's called a precedent transaction. So we can use it for M&A. The same thing, we can use it for private companies. I'm gonna do an IPO. What am I worth if I go public? What are similar companies with these profiles worth? What did they go public for? I can use that as a proxy. Precedent transactions. I'll pause. Does that make sense?
Yeah, just real quick, you kind of talked about it's easier for us to defend on lawyers. Let's say you had an IPO recently, why would lawyers be coming after you? They're saying the bank overvalued the company and tried to or
Yeah.
what?
So let's say you did an IPO, I'll make up a number at 10, and then suddenly 30 days later, the company's trading at 5. People will start, the sharks are going to start swimming, and they're going to say, was everything fully disclosed about the company, especially if some new information comes out that looks bad. So I'm just telling you, there's a whole industry of lawyers out there that are looking for reasons to sue companies whenever things may or may not work out according to plan. Right. That's why companies are very careful with their public statements. And that's also why, for example, if you do an IPO, you got to list every risk out there in your prospectus. Because if you don't, and that pops out of the closet, someone's coming after you for that. Because it's a high stakes game if you put in a bunch of money and you quickly lose it. That's why it'll be interesting to me to see how DJT plays out over time. Just because, I know they're disclosing this, but when you got a company that has 5 million of revenue, loses 200 million a quarter, has declining amounts of users, and is worth, I don't even know what the value of the company is today, $3-4 billion. I don't know where you get that value from. It's like a meme stock, right? and at some point, if a bunch of people lose a bunch of money because it reverts back to its cash flow value, then I think you're going to see a bunch of litigation over that.
Okay, so it's never on the investors for doing due diligence kind of thing. Because I mean, GameStop's been I think a pretty terrible stock for a while, but if it suddenly dropped, pretty low, do you think the same thing would happen?
Well, what I'm saying is, if in due diligence as an example, this can happen in M&As. Like companies will say it wasn't put into the due diligence. You had risks. We bought you and we found out things that you didn't disclose. That leads to litigation. And that should have adjusted the price that we pay. Now, some of it, legit, some of it's not. But, and sometimes you find out things after the fact. Not everybody sues. But regardless, I'm just saying that you got to be wary out there.
Okay. No, that makes sense.
All right. So back to our slide deck. Where'd it go? Is it sharing? Share, please. All right. So again, problem with precedent transactions, we're starting to get into lack of information availability. Timing might matter. If you bought something in a recession versus a boom market, might have different prices. Finding comparables is an issue. And synergies could play a role. All right, for purposes of this class, I'm going to simplify to 3 multiples. All right, not even 4. We're just going to do 3, given the shortened nature of the class. All right, we're going to focus on price to earnings, PE. We're going to focus on enterprise value to sales or revenue, and we're going to focus on enterprise value to EBIT. Those are the 3 ratios and multiples that we're going to focus on and understanding. All right, so let's start out with a multiple. Multiples are based on key value drivers. If you remember our key value driver equation, we did it for continuing value in our DCF. We did it in week 1 for the class, and we've been using it all semester, that key value driver equation. So here's the way this table works. What I've done in this table is I've taken the key value driver equation. I started with 100 of NOPAT and a 10% WACC, right? And then I plugged in these ROICs from 6 to 16%, and these Gs from 1 to 5%, and these are the results. Okay, so if you had 100 NOPAT, 10% WACC, 10% ROIC, and 1% growth, that's the 1,000. That's the $1 billion. So 100 million NOPAT, the company would be worth $1 billion. That's the result of the key value driver equation. Question for everybody: why in this column right here, why as the G's go from 1 to 5% does the value stay at 1,000, at basically $1 billion? Why is the value not changing as the growth changes for that column?
Your spread is 0.
Exactly. And if I go to the left of that, 6 and 8%, why is the value going down as the G's increase? So look at 6% ROIC, 1% growth, then 2, then 3, then 4, then 5. So over here.
Just because our ROIC is less than the cost of capital.
And when you grow it, you destroy value at a faster rate. So this table is just illustrating what we kind of already know intuitively and from previous assignments. Same thing. When you go to the right of 10% and you have a positive spread, ROIC against WACC, then the faster you grow, the more valuable you become. Okay. And that's just the math played out with the key value driver equation. Are we going to clear where these numbers are coming from? All right, let's go to the next slide. All right, so here's how multiples are created. If I take the table that we built on the last slide, put it at the top of this slide, okay? And then what I'm going to do is right here. This is the table from the previous slide. What I'm going to do is I'm going to say, okay, if we had 100 NOPAT at a 35% tax rate, that's 154 of EBIT. So 154 of EBIT at 35% is 100 of NOPAT. So if I know my NOPAT and tax rate, I'm going to work backwards to an EBIT. Okay. So here's how an enterprise value to EBIT multiple would work. If I took 1,000 right here, billion, divided by 154 million, that would be a 6.5 multiple of EBIT. Okay. So basically a zero spread is 6.5 times EBIT in this industry. Okay. If I took 833, 6% ROIC, 2% growth, okay, 833 divided by 154, that would be 5.4 times EBIT. So that's essentially how multiple is created. You just take the value of the company, you divide by the basically the denominator, EBIT, EBITDA, earnings per share, revenue, and then basically that gets you a multiple. So here's my question to the group. Based on this data, if there was a company that was trading at 6 times EBIT, what would that tell you? If we had a company trading at 6 times EBIT, what would that tell you?
It would
Hello?
take the earnings, or it would take the company 6 years to make that, to earn back what they're worth today.
Okay. And 7 times EBIT, it would take them 7 years to earn back. That's one thing it would tell you, but what else would it tell you? In the context of the key value drivers, what else would a 6 times EBIT tell you?
The growth
They're-
is 1% with ROIC of 6%.
Is that the only possible answer
just that
for 6
their,
times EBIT?
just that their WACC is more than their ROIC.
Okay, so 2 things. One, the second point that was just made about WACC and ROIC, I want to come back to. But I just want to start out with the 6 first. Where are 6s in this table? Is this where my cursor is that the only place that there's a 6?
Correct.
No.
Oh, I
Where
mean,
else could there
6
be a
is down.
6?
Okay.
Somewhere in here could be a 6. Okay, so the point about multiples, and this is a really key point I want to illustrate for everybody, is a 6 multiple can have a range of answers. They could be 1% growth at 6% ROIC, 2% growth at like 7.9% ROIC, like somewhere in that range of G's and ROICs is where you're likely to get a 6. But in all cases, it would suggest a negative spread. So somebody trading at 6 times ROIC would likely have a negative spread in this industry. Low growth at negative spread. Because any company with a positive spread would be to the right of this. Any company with a negative spread would be left of this. And a lower than average multiple suggests that it's not expected to have the same spread as the average for the industry. The same would be true if I told you there's a company that's trading at 7 times EBIT. Where are the 7s? 7, 7, somewhere in here, 7. So any of these permutations can get you to 7 times EBIT. So that's the point. All of those permutations suggest low growth, 1 to 3% at a positive spread. So this is what I mean by kind of the oversimplification. So multiples don't give you an exact answer because technically when you work backwards, you can get with the key value drivers a couple of answers, a couple of different sets of numbers that give you the same answer. But so it's really more about the range. But what the ranges tell you is 7 times EBIT, that company likely has a positive spread compared to the others in the industry. 5 times EBIT, 6 times EBIT, that company probably has a negative spread relative to the industry average 6.5. That brings up another important point where you're digesting all this. A naive comment that a lot of people will make on CNBC is they'll say, buy this company because their multiple is below average. They're cheap. They're on sale, right? And the implication is if you buy them in a low multiple, that they should eventually go to the average, right? No. The way they go to the average, if you're trading at 6 times EBIT, the way you go to 6.5 times EBIT, the way you go to the average is you got to improve your ROIC or you got to improve your growth. If you don't improve your growth or your ROIC, you're not going to the average. So there's a reason why companies traded it, it's called a discount, trade below the average of their peers, right? And the reason they're trading at a discount is because multiples are just an expression of future growth and future spread. That's all they are. Multiples are future growth, future ROIC, and future WACC. That's a multiple. That's all it is. That's what the key value driver equation tells us. So an average multiple is average growth, average spread. A below average multiple, discount is what we call it. That's below average growth spread combination. A premium, you're trading above the industry average. That is a growth spread combination that's higher than the industry average. And the industry average is the average gross spread. That's multiples. And that's very important to understand when we're about to analyze these things. I'm going to pause because I threw a lot at you. Questions?
Okay, going back to when you were talking about CNBC, because I've heard that before. That's why I'm like kind of
Yep.
like, oh wow. So by saying that though, are you saying that it's a buy? Like if Kramer would say that, say it's a buy based off of, I'm going to say like Boeing or something like that. It usually is always pertaining to, or no, sometimes always pertaining to like something happening or some type of event just happened. So is that commonplace to kind of say something like that and like adding it, or are you just saying that because or is that being said because you really don't know whether or which way it's going to go, but you want people to buy into the stock? That makes sense.
So when we look at Boeing, and I'll just start out with spread as an example. Hopefully you're seeing my Bloomberg screen.
Mhm.
Bloomberg. If I just pop up their spread, what you're going to see is right now Boeing's performance, for lack of a better word, sucks. All right. They're destroying value. They got a negative spread. They're losing money. They're having all sorts of problems. Right now, Boeing fired their CEO essentially and hired a new CEO with the whole goal to fix the business, fix the operations finally, put the quality issues behind them, put the manufacturing issues behind them, get back to the growth track. Okay. So right now they have a negative spread. But if you actually look at their future, what the analysts are saying, on a 5-point scale, right, there are 4.06 out of 5 because 20 analysts put buys on them. Why are they putting buys on them? You're not going to put a buy on Boeing if you do a DCF with a negative spread. You're not going to get an increase in your share price, right? So the analysts think that the share price is going to go up. You can see them here, 270, 208, 207, 215, 232, 218. Their share price today is 165.
Mhm.
So you did an as-is on this. If we did an as-is on Boeing, what you'd have to do is you'd have to have higher cash flows to get to a DCF of a higher price. It's the only way, right? So here's the point. In order for Boeing to have higher share price and higher cash flows, they got to improve. So essentially, I might pay a multiple for Boeing that's higher, or at least say, look, they're trading at a discount to their peers, but they're a bargain because I think they're going to improve. But the whole point behind that is their ROIC will get better. Because their ROIC doesn't get better, you don't get to these share prices.
Gotcha.
So they are trading at a discount because they're effed up now, but the market thinks they're going to get their act together. And you can see that in the forecast for the earnings, which are the basis for the DCF, that Boeing's revenue, this is today, last year, 78 billion, by 2027 is expected to grow to 112 billion.
That's crazy.
Boeing's EBITDA, 1 billion, expected to grow to 13 billion. Net negative income, 2 billion gap to 8 billion income. So the point is, there's an expectation that they're going to improve. So if you're buying Boeing now because they're cheap, then the reason they're going to improve is that their growth ROIC is going to be better. And that's why you might want to buy them. But let's say we had another company that had really poor performance and is not expected to change. They're just a basket case. They're the company's just continuing to do poorly. Well, then they're probably going to stay at a discount. Just like you'd probably call them a sell in the DCF model. Same concept. Does that make sense?
It does. Thank you.
Sure. So what I'm just telling you is, if a company's trading at a lower multiple than everybody else, there's probably a reason for it. Okay. And you're going to trade a higher multiple. That means you got to get to a higher level of growth return combination to achieve that multiple. Okay. So you don't just go there. You don't see two companies with different growth return combinations trade the same value. You wouldn't have the same DCF. You shouldn't have the same multiple. Good question. These are important questions. I want to make sure everybody can connect the dots because we're about to do some analysis on there that make sure that you have to understand these core concepts. All right. That's the key value driver equation on the right-hand side of the screen. The difference here is when you do price to earnings multiples, PEs, right? Price to earnings is based on earnings per share, which is net income. It's not NOPAT free cash flow, right? And price per share is literally that. It's the equity value of the shares. So what you can do is you can use the exact same key value driver equation. You can plug in equity values and you can actually solve for a PE. So NOPAT becomes net income. ROIC in the equation is replaced by return on equity in the equation. Growth in the equation is growth in net income, long-term growth in net income, not growth in sales or cash flow. And cost of equity replaces the WACC. So using the exact same key value driver equation, you can estimate an equity value of the firm as opposed to an operating value of the firm. Okay. So how does this play out? Using this equation, key value drivers with equity put in. Same concept as tables. So on this slide, we have key value driver equation results. We're going to start with 100 million in net income and a 10% cost of equity. Okay. At these return on equities and these G's, these are the results. So 100 million in net income, 10% cost of equity, 10% ROE, negative spread, any level of G, company's worth $1 billion. What is the price to earnings multiple? 1 billion divided by 100 million, PE of 10. Same concept. Company's trading at a PE of 8. Well, where are my 8s? Well, they're over in this range. 8 somewhere in here, 8 somewhere in here. I know that's a negative spread. Where are my 12s? Well, 12s would suggest probably somewhere here to here. That's in the positive spread territory. As we said, companies at 8 don't just arbitrarily go trade at companies at 12. You could say this is a discount to that company, but the only way that they're going to trade at 12 if they're trading at 8 is they got to improve their ROE. If they improve their ROE, they'll trade at 12. That's Boeing. So the idea for Boeing is Boeing's over here right now, right? And the market's saying, we think that they're going to get over here. That's why you should buy them. They're undervalued. But they got to go do it. If they don't do it, then they're going to go, they keep earning down here, they're going to be worth down here. But that's the same idea of the multiples. Does that kind of make sense? Questions? All right. So again, as a reminder, even though we will do PE, we still prefer enterprise value for reasons I told you earlier, is that essentially the problem with PE is it's based on net income. And so there's a lot of things that could distort net income, and it just makes the PEs a little bit less comparable, right? Where enterprise value, EBIT, EBITDA tends to be less distorted because they're EBIT and EBITDA less impacted by accounting adjustments and less impacted by things below EBIT. So therefore, they tend to be more normalized. Now, here's the thing. Let's say you want to do EV to EBIT. How do you do an EV to EBIT multiple? This is what's interesting. It's just the key value driver rearranged. This is the key value driver equation. I want to get to EV to EBIT. How do I do that? Well, take our NOPAT times 1 minus G over ROIC divided by WACC minus G. Well, NOPAT is EBIT after tax. EBIT times 1 minus the tax rate. If I divide both sides by EBIT, enterprise value to EBIT, that EBIT cancels out. I'm left with 1 minus the tax rate times 1 minus the G over ROIC over WACC minus G. This formula, which is the rearranged key value drivers, so it's still key value drivers, directly allows you to calculate an enterprise value to EBIT multiple. Those are the drivers. And so what's different about the EV to EBIT direct formula than the traditional key value drivers is you break out the impact to taxes. So what are the drivers of enterprise value to EBIT? Tax rate, growth, ROIC, WACC. What were the drivers of your bull, your bear, and your target? Tax rate, growth, ROIC, WACC in the DCF. Those drive enterprise value to EBIT. Those drive enterprise value multiples and DCFs. Enterprise value to revenue multiple. I can actually get from the key value driver formula to an enterprise value to revenue multiple. Rearrange math. NOPAT is revenue times margin, after tax margin. So revenue times EBIT after tax divided by revenue. If I take both sides divided by revenue, the revenues cancel out, and I'm left with my margin times the 1 minus the tax rate, 1 minus G over ROIC, WACC minus G, basically all that stuff. So that's the direct formula for enterprise value to revenue, right here. Here's what's interesting. All of this from here, right there, is that formula. So if that is the formula for enterprise value to EBIT, then enterprise value to revenue equals the EBIT margin right there times the enterprise value to EBIT multiple. If we take the enterprise value to revenue multiple and we divide by the enterprise value to EBIT multiple, we get the EBIT margin. We've been doing that for 2 weeks. That's what we did in our DCF. If you remember in the assumptions tab, where I had you take the enterprise value to revenue and divide by the enterprise value to EBIT, I knew mathematically that had to get you this number, the EBIT margin. This divided by that is that. Because all multiples are based on the key value driver equation, and it's just rearranged math. That's all they are. And so therefore, multiples are an expression of growth and spread. Threw a lot at you. We're about to take a break, but before we do, because on the other side of the break, we're going to start analyzing real data and trying to explain why companies are trading at higher or lower multiples, premiums or discounts versus others. But this was the math behind it that was also in the book. Questions before we take a break? All right, so we're gonna take a break, 15 minutes. We'll say let's come back at quarter after. So actually give you 17 minutes. I'm gonna stop the recording and then we're gonna do some analysis on the other side. All right, recording is back on. Welcome back, hopefully from the break. So what I want to do next is start the process of analyzing the multiples. And again, this is going to be the core for your assignments and your group projects. So I'm going to start with this. So here are some multiples for, we're going to start with the airlines from a few weeks ago. This is the PE multiples for Southwest, Delta, and American. Okay. And so this is actually based on real world data at the time. All right. And we'll talk next after we kind of analyze these multiples about where the data comes from and how to put this together. But the idea is these are the 4 elements of the key value driver equation. Okay. Expected profit, growth, return on equity, not ROIC, and cost of equity. These are the results of the key value driver equation. And so instead of the value is the enterprise value, the operating value, this is going to be the equity value. And so the way the PE works, if you take the equity value divided by the income, you get a PE. Okay. Now, this is the FY2 PE from the EEO screen. So basically next year's price to earnings multiple. Okay. And just as a reminder, go back to Bloomberg. let's take, I don't know, use Boeing as an example because I'm here, EEO. So for example, this is forward year 2, okay, for Boeing right now, 1, 2, right? If I took Boeing's current share price, which today they closed at, where'd it go? Load the screen. 165.04. If I took 165.04, which is the current share price of Boeing, and I divide it by next year's earnings, 4.443, that would be a price to earnings multiple of 37. If I take the 165 price divided by third forward year, 8083, that would be a 20.42 PE. Okay, so these multiples that you've already been using, it's basically the value of the company today divided by the forward numbers. That's how you get the multiples. Okay, so again, we'll come back to that. But for our purposes, calculated results, these were second forward year PEs for Southwest, Delta, and American. Okay, so here's the analysis that we're going to do. Okay, and so the idea is using the key value driver equation, just like an as is, we match mathematically the multiple that we see in the real world. So Southwest PE was 10.7 times next year's earnings. Delta was trading at 5.85 times next year's earnings. American was trading at 3.39 times next year's earnings. In fact, it's the sad state of American Airlines that, as somebody said earlier, you can buy all of American for about 3 years worth of net income. That's all they're worth. The next 3 years, that's it. All right. So what we're going to try and do is explain the differences in the PEs. Okay. Now, if a PE is trading higher than another, Southwest higher than Delta, that's called a premium. Southwest PE is trading at a premium to Delta. If a PE is trading lower than somebody else's, that's called a discount. Delta is trading at a discount to Southwest. Okay. So the analysis we're going to do is we're going to compare this company column B against two peers. So Southwest against Delta. Why is Southwest trading at a premium, 10.72, to Delta's 5.85? These are the 4 factors, right? But what we really realize is there's 3, because if we do key value drivers, we realize that the net income doesn't matter, doesn't affect PE. Remember that from the first week of class. So what really explains the multiples are the growth in the spread. So here's the growth in spreads for these 2 airlines. First thing we notice is Southwest has a positive spread, 11% ROE against a 9.7% cost of equity. Delta has a negative spread, 6.9% return equity against a 10.9% cost of equity. Okay, so that's one of the reasons why Southwest is trading at a higher PE. Second, Southwest is growing their positive spread, 2.3% growth, positive spread. That gets you a high PE. Then this 4% growth rate of a negative spread is leading to the lower PE. So why is Delta trading at a discount to Southwest? Because even though Delta has higher growth, 4% versus 2%, Delta is growing a negative spread, 7% ROE against 11% cost of equity rounding off. Southwest is growing half the rate of Delta, 2%, but they're growing a slightly positive spread, 11% ROE against about a 10% cost of equity. That's why Southwest is trading at a premium. There's a third reason, and this one is often overlooked. Southwest is also trading at a premium because they have lower risk. Their cost of equity is absolutely lower than Delta's. If I have a lower cost of capital, my discounted cash flows are worth more. So the third reason is Southwest is trading at a premium is because of their lower cost of equity. Because if they trade at the same cost of equity, Southwest PE would be 9. But because Southwest has a lower cost of equity, Southwest PE is 10.72. So there's 3 reasons why Southwest is trading at a premium to Delta. I'm going to pause. Everybody follow that? All right. Why is American trading at a discount to Southwest? Well, similar reasons. Southwest has a positive spread of about 1.4 points, 11% return equity against 9.7 cost of equity. America has a negative spread, about -5 points, 6% ROE against 11% cost of equity. American is also growing that negative spread more than twice as fast. They're expected to grow that negative spread at about 4.77% a year. Southwest is growing their positive spread at about 2% a year. Not growing as fast, but they're growing fast with a negative spread. That's hurting the PE. And American has the highest cost of equity. That is further reducing their PE. So all three things, they're growing the negative spread. In fact, they have a negative spread and they have the highest risk, are why American is trading at a discount to Southwest. Questions? That's the analysis you're going to have to do for PE. Let's look at PE in another industry. Here is pharmaceuticals. And I didn't finish this one, so I'm going to hide this. Look at these three companies: Johnson & Johnson, Merck, Lilly. Right? Why is Johnson & Johnson, column B, J&J, trading at a discount to Merck, or sorry, Eli Lilly in column D? Why is Johnson & Johnson trading at a premium to Merck in column C? Okay, so let's do Johnson & Johnson against Merck. Why is the PE at J&J higher? Right? Well, Johnson & Johnson has a lower spread than Merck. 32%, still pretty good ROE against a 7.5% cost of equity. It's very high. But Merck has a 41% ROE against a 7% cost of equity. So Merck has the higher spread, right? But the problem with Merck is they're expected to shrink over time, negative 0.8% growth into perpetuity. Johnson & Johnson, 0.1% growth. So they're kind of staying flat. The problem with Merck is they're expected to shrink. So that negative growth, about negative 1% a year, is why Merck is primarily trading at a discount. Even though Merck has a slightly lower risk, 7.1% cost of equity versus 7.5%. But even if they have the same risk, Merck would still be trading at a discount to J&J because of the negative growth rate. Why is Eli Lilly trading at a premium to J&J? Well, number one, Eli Lilly is expected to have the biggest expected spread in the future, about 60 points, 68% ROE against an 8% cost of equity. They're also expected to grow that spread at the highest rate of the three companies at 5.8% a year. So it's high growth, high spread. That's why they're trading at a PE of 40. And that's what you would expect, right? And oh, by the way, they have the slightly highest risk. So that's kind of dampening this. If Lilly had the same cost of equity as J&J, their PE would actually be 55. So they got a little bit of a headwind on risk, but what's compensating for that is the high growth, high spread. And that's why Lilly is trading at a premium to J&J. J&J is trading at a discount to Lilly. Questions? And by the way, what's behind this? Why does Lilly have such a high growth rate and a high expected return? Does anybody know? In the real world, what's behind that?
The fact that they have Ozempic, which is like the current high drug that's popular, but they also have a Alzheimer's drug coming down the pike that will help as well. And they're trying to get a pill for weight loss as well, because Norvasc or Nordisk is coming up with their own pill for weight loss.
Close. So you had it all right, except Ozempic is Novo Nordisk. Lilly's version of Ozempic is called Mounjaro.
Mounjaro, yeah.
But the whole point is exactly, you had the right idea. It's that booming weight loss. Lilly's taken advantage of that. J&J doesn't have that. Anybody know why Merck has a negative growth rate? We actually talked about in the first day of class. You can reach deep into your memories.
Their patent expired.
They have a drug called Keytruda, which is booming, which patents expect to expire in 2028. And they're going to start losing the patent protection, and they don't have anything to replace it on that scale. So that's why they have a negative G. Negative G doesn't always mean you're going away. A negative G could mean that the future is just a little bit worse than the present. Industry number 3, tech firms. Meta, Microsoft, Alphabet / Google. Why is Meta trading at a discount to Microsoft? Meta's trading at a discount to Microsoft. These are both very high growth companies, 7.2% G against 7.6% G. Microsoft's got a higher growth rate. Meta actually has a slightly lower spread. 30% versus 11, it's about 19 points. 33 versus 10. So Microsoft is trading at a premium to Meta because they got a slightly higher spread, a couple extra points, and they're growing at about 0.44% more per year. And Microsoft has slightly less risk, 10.2% cost of equity against 10.8. That's why Microsoft is trading at a premium to Meta. That's why Meta is trading at a discount to Microsoft. For Alphabet / Google, this is before the antitrust litigation, the guilty verdict yesterday. Alphabet has the lowest growth of the three, 6.5%. Now they have the lowest spread of the three, 28 versus 10 is about 18 points. So they got the lowest spread, they got slightly lower growth, and that's why they're trading at a discount, 20 versus 21. That's not that far of a discount, even though Alphabet also has slightly lower risk than Meta. But what they really lack is a little bit less growth and a little bit less spread. That's why Alphabet is trading at a discount. But here's what I want you to understand at a macro level. Do you see these PEs? They're the low 20s. And do you see these PEs, which are single digits to 10? There's a reason for that. There's a reason why the airline industry is trading at these low multiples, because they have terrible spreads. There's a reason why these tech companies are trading at high multiples, because they have great spreads at high growth. We know that from key value drivers. That's what we're seeing played out. That's what we're explaining using the key value driver equation. Here's the PE for Verizon, AT&T, Comcast. Chris?
I don't know if you covered it, but does the capital structure play a big role in the PE?
Well, capital structure will affect cost of equity.
Right.
So it does. And capital structure affects net income because interest is part of net income. So capital structure, as it talks about in the book, does distort the PE. High levels of debt can actually make the PEs look higher.
Okay.
Take your operating profit, subtract the interest expense, you get lower net income. And so as you lever up, your PEs can look a little bit more distorted and higher than they otherwise should be. Time to practice. Somebody explain to me why AT&T is trading at a discount to Verizon. Try and make these numbers a little bigger. Why is AT&T trading at a discount to Verizon? Let's take a shot at that. All right, Raymond.
AT&T one has a higher risk because the cost of equity is higher than Verizon.
Okay, the 8.2 versus the 7.7.
It has a lower growth rate than Verizon.
1.5 versus 2. Got to use numbers.
I'm sorry. Okay, and I believe no. Not sure. I think that's it.
So why is AT&T's spread, or sorry, why is AT&T's multiple lower than Verizon's? Why is AT&T at a discount? What connect the dots there, Lucas?
Verizon's spread is less worse than AT&T's. So it's a better spread.
Give you, that's one of the reasons.
Oh, I would say, I guess Verizon it's growing its spread at a higher rate.
But if you grow a
than
negative
AT&T.
spread at a higher rate, that makes it worse.
Oh, right.
Why? There's a third reason. What's the third reason? Growth, spread, and reason number three,
The cost of equity is a little bit higher
for who?
for AT&T, about
Yes.
5%.
Yeah, the extra 0.5% of cost of equity is lowering the PE. We can do math. So if AT&T had the same cost of equity as Verizon, their PE would be 8.13, not 7.52. Okay, but it's not. It's higher. Therefore, the PE is even lower. So one of the other reasons Verizon is trading at a premium is because they have a lower cost of equity. So just remember these three reasons when you explain. Give you one more. Here is a company, Siemens Energy, Schneider Electric, Vestas, which is a renewable energy company in Europe. Somebody help me explain these PEs. Why is Siemens Energy trading at a discount to Schneider Electric? 15 versus 23. Theodore?
Okay, so Schneider has a higher spread. Does it look like 8 versus 3?
Okay.
And it comes with a slightly higher risk or cost of equity, but they're also growing the net income at a higher rate with the higher spread. So Schneider gets the premium.
Yeah, they get the higher growth of 7% versus 5 with the higher spread. Higher growth, higher spread, higher PE. But you mentioned cost of equity. The 9.5 at Schneider versus Siemens. Is that helping or hurting Schneider's PE?
It's hurting them, slightly higher risk than Siemens.
Yeah, so two things are helping Schneider be higher. One's actually mitigating that. So just make sure you understand that the cost of equity is hurting it. Because if Schneider had a 9% cost of equity, key value driver formula tells us that their PE would be 29. So there's a little headwind for Schneider, but they're still doing much better because the higher growth, higher spread expectation. Why is Vestas trading at a premium to Siemens?
Both the cost of equity is lower, so therefore Vestas has a lower risk, but also the spread is much larger than Siemens. You're looking at what is that, 14? No, 16. Sorry, 16 versus a 3. So for those reasons, the one thing that does hurt Vestas is the fact that their growth rate is lower for net income, the 3.6 versus the 5.32.
Right, Logan, you're generally right. Although I'll tell you, if this were your homework assignment, if this were 4 points, I'd give you a 2 because you didn't use A numbers.
Okay.
Got to use numbers. That's for everybody's benefit. So you had it exactly right with what you were saying. Please continue to use the numbers. Because if you go back and watch this video, it's being recorded. And what I'm saying is, when you're listening to him, you might have trouble following along if you're not as familiar with what he's looking at. If he uses numbers, it's easier to follow along. It's like putting the cursor on there. So please use numbers. But yes, that's why Vestas is trading slight premium. They have a much better spread, but they just lack the growth of the higher spread. And they also have a slightly lower risk. Questions about PE analysis? All right, we're going to go to multiple number 2. Multiple number 2 is the enterprise value multiple, EV to EBIT. Okay. Down here is the EV to EBIT formula. Down here is the EV to EBIT from the EEO screen, second forward year. Okay, so matching, these are the 4 inputs into the EV to EBIT equation that was derived in the book and in the PowerPoint slides, the rearranged key value drivers. So you plug in those 4 numbers, you get that value. So when we do EV to EBIT, we are doing the WACC, not the cost of equity. We're doing the ROIC, not the ROE. We are doing the tax rate, expected tax rate, similar to the DCF tax rate. This is the long-term ROIC, and this is the long-term growth rate, not the 1-year growth rate. Okay, so why on an enterprise value basis is Southwest trading at a premium to Delta? Well, let's look. Number 1, tax rate. Southwest is paying higher taxes than Delta, 23.5% versus 17.8%. That should hurt Southwest enterprise value to EBIT multiple. Okay, so that's kind of working against them. That's not why they're trading at a premium. Number 2, 4.7% growth rate, 5%, 4.79% growth rate. On an operating basis, right? This is growth in EBIT now, not growth in net income. Delta's growing slightly more, 4.79 versus 4.7, but these are pretty close to each other, right? So why is Southwest trading at a premium? Southwest spread is negative on an operating basis, 7% operating ROIC versus 8% WACC, 7% versus 8.5%. A little bit better with Southwest, but still negative. So they're basically growing a similar rate, similar negative spreads. Why is Southwest on an operating basis trading a slight premium? Because Southwest is perceived to have a lower WACC, the 0.5% WACC. So it's really that 0.5% lower WACC and slightly less negative spread is why Southwest is trading at a premium to Delta. Interestingly, American, which on a PE basis was only worth 3 times net income, is worth 8 times EBIT. Okay. Why? And the answer is they have the lowest growth of the 3, 4.27% versus 4.79 and 4.7. They also have a negative spread, 5.8 against 6.7, but they are basically slightly less growth of this negative spread is helping American. And the other thing is American has the lowest WACC of the 3, right? Because American has a lot of debt in their capital structure. And the other thing that's working against America is the highest tax rate, 25.3% versus 23.5% at Southwest. So why is American kind of at parity with Southwest? Short version is they're destroying value at a slightly less rate, 4.3% versus 4.7. And that's why, despite the fact that they have a worse spread and a higher taxes, they actually trade at a slight premium to Southwest. That and the lower risk. Why is Delta trading at a discount to Southwest? Again, similar growth. Delta has a lower tax rate, 17.8%. That should be helping the EV to EBIT. So basically, they also have a little bit more of a negative spread, 6.92 versus 8.5. So the real reason, it's the 8.5. The driver for Delta's lower multiple is the WACC of 8.5% versus Southwest of 8. That's why they're really trading at a discount. Those are the operating multiples. Let's jump over here to pharma. These are the EV to EBITs for, and again, I didn't finish this one, so I'm going to hide this. J&J, Merck, Lilly, right? As opposed to PEs. So why is J&J trading at a slight premium to Merck, 12.16 versus 11.8? Well, number one, J&J is expected in the future to have a pretty high spread, 41.8% against 7% WACC, Merck 1% against the 6.5% WACC. The reason why this negative spread is not hurting Merck a lot is because they lack any growth on an operating basis. So if you just kind of maintain that spread, you don't grow, it doesn't get worse. It doesn't get better. So for a slightly lower tax rate, the real reason that they're competitive is because of this lower cost of capital. If Merck's cost of capital was 7.3, they'd be trading at more of a discount. Why is Lilly, Chris?
Once you finish this, I had a question on the airlines.
Okay. I'll
Sorry.
go back to this. Why is Lilly trading at a premium? Similar reasons. It's all about the growth. This is Manjaro, 6% long-term growth. Lowest tax rate, 14. And highest spread, second highest spread, 25% ROIC against a 8% WACC. But this high growth, high spread is why they're trading at a premium. 37 times EBIT versus 12 times EBIT. That one's pretty easy. Very similar to the PE. Right, back to the airlines.
Yeah, the tax rate here, is that driven by domestic versus international travel?
Yes.
Okay.
It gets back to the guidance, and depending on where you're earning your revenue, what jurisdictions, and what tax rate you pay in those jurisdictions will impact the tax rate. So if you have more domestic, you're going to have a higher tax rate than probably other airlines.
Okay.
Good observation. Tech. Somebody tell me about Meta and Microsoft. EV to EBIT. Why is Meta at a discount to Microsoft? Lucas?
So Microsoft has a higher growth of 7.19 compared to the 6.6 from Meta. Microsoft also has a higher spread, about 35% versus the 21% or so from Meta. So it's growing at a faster rate with a better spread. And lastly, Microsoft has a lower cost of capital, so it's less risky.
Actually, there's one more factor here. There's a fourth factor when you do this. Tax rate.
Oh, yes. Microsoft's tax rate hurts them, but the other factors outweigh the slightly higher tax rate.
Yeah, matter of fact, when you guys get this model, you could put in the 17% tax rate. At that equal tax rates, it wouldn't really change the multiple that much. Okay, so it's a little bit of a hurt, but the real reason Microsoft is doing better, as you said, high growth, high spread relative to Meta. Why is Alphabet trading about the same slight discount as Meta? What makes them similar? Although I would call it slight discount for Alphabet. Meta against Alphabet.
I was gonna say Meta or sorry, Alphabet has a less, by about percent less growth rate, which hurts them. But their tax rate is up above about 4%, which is pretty nice. And they also have a bigger spread of about 23% spread to a 21% spread. So the spreads are close to each other, but they're growing at a slower rate, even though they're paying less taxes.
Yep.
So all things considered, they're pretty darn close to each other. It's just that they have slight differences in them, and Google is paying less taxes, which is helping them compete with their lower
Remember
growth.
when I showed you that table before the break and I said permutations? This is an example of permutations. Alphabet basically has slightly lower growth but slightly higher spread. Meta has slightly lower growth at slightly higher spread. Meta has slightly higher growth at slightly lower spread. They kind of end up pretty close to the same point at the same level of risk. 10.3, 10.5 WACC, pretty simple. So you can kind of get to the same multiple with slightly different growth ROIC combinations, and Meta and Alphabet are fairly similar in that way, but they get there slightly differently. Nuances. All right, Verizon. Tell me why Verizon is trading at a discount to AT&T, EV to EBIT.
So Verizon has a negative spread of roughly 2% versus a negative spread for AT&T of roughly 1.5%. And then if you pair that with the fact that Verizon's estimated growth is 1.5%, meaning they're destroying value more quickly versus AT&T's 1%. So you have a negative spread getting worse more quickly than you do a negative spread getting worse but more slowly. They pay about the same taxes, so that shouldn't have they pay exactly the same tax rate, actually at 23.5%. So that shouldn't impact the ratio. So it's coming down to the more negative spread and faster value destruction for Verizon.
You're 90% of the way there. There's a fourth factor.
Is it the WAC?
Yeah, good call, Sarah.
So say something more about the WAC.
Sorry, me or
either. Sarah, why don't you jump in?
Okay. The WAC for AT&T is at 6.4, and Verizon's is at 6. So the higher the WAC, it essentially just hurting AT&T.
Yeah, so that's not why AT&T is trading at a premium. It's what you said earlier. It's the lower growth at the less, they're destroying value at a lower rate.
Yeah.
Is really why AT&T, but they're both destroying value.
Yep.
Right. So Sarah, since you did a great job jumping in, you want to do Verizon against Comcast?
I will attempt. I will do my best.
Jump in and help you.
Okay. So I guess the first thing, Comcast has a higher tax rate. So that's gonna 27, while Verizon has 23.5. So that's going to favor Verizon in terms of I guess their value. And then in terms of the spread, Comcast has a positive spread of 0.2, but they're only growing at 1%, while Verizon has a negative spread of about 2 and is growing that at 1.5%.
Okay.
And then Comcast, I guess, has the higher WAC. So I guess after looking at this, though, I would think that Comcast, I don't know why, but I was thinking that Comcast would actually be doing better. But I guess maybe the tax rate hurts them more.
Well, the tax rate at 27 does make a difference.
Mm-hmm.
Let's put this down here to 23.
And because like their spread is essentially almost like 0 and it's growing at 1%.
And so this is something that's very important, key value drivers. If you have a 0 spread, then growth doesn't matter.
Yeah.
So that's the one thing that's, you can argue, is benefiting Comcast, is that they're at least kind of trading close to treading water. AT&T and Verizon are underwater when it comes to their spreads. So that growth hurts them more.
Got it. Okay.
Everybody clear on those? Good job. All right, multiple number 3, EV to revenue. I'll go back to the airlines. So all these multiples, another way of saying it, the simple version, if I drive $1 of EPS, it should mean $10.72% of value, $10.72 of value. Dollar of EPS, $5.85 of value. Dollar of EPS, $3.39 of value. Dollar of EBIT, $8 of enterprise value. Dollar of EBIT, $6.82 of enterprise value. Dollar of EBIT, $8.19 of enterprise value. Okay. The third multiple, EV to revenue. For every time Southwest sells a new $1 of tickets, it adds 46 cents to their enterprise value. Every time Delta sells a $1 of tickets, it sells 87 cents to its enterprise value. $1 of revenue at American adds 67 cents to its enterprise value. That's EV to revenue. Okay. Remember, in the formula, EV to revenue divided by EV to EBIT is margin. One of the biggest drivers of EV to revenue is your margin. Okay. So that's the point. Like the bias is if I sell things at a higher margin, then the more I sell, the more cash I'll generate. Theoretically, the more I would be valued. Okay. That's just the simpleton's view of EV to revenue. So margin is a big driver of EV to revenue. However, if you remember the formula, EV to revenue divided by EV to EBIT is the margin, then built into that EV to EBIT multiple is ROIC. So it's not just margin, it's also your ROIC. So what I've done here is based on this expected ROIC and this expected margin, because if we take the EV to revenue divided by EV to EBIT, we know what the margin needs to be. Then margin times productivity equals ROIC. So after-tax margin times productivity equals ROIC. So you can actually back into, which is what this model does, if I know the estimated margin for the multiple and the tax rate, and I know the ROIC, I know what that productivity has to be. Invested capital to sales. So why is Southwest at a big discount for when they sell tickets? Number one, relative to Delta, they make 5.7% pre-tax margin when they sell a ticket. Delta makes almost 13% of pre-tax margin when they sell a ticket. That's going to drive a higher EV to revenue. Number two, after tax, 4.3% versus 10.5. Again, Delta making more after tax when they sell a ticket. The one thing that's hurting Delta is to drive $1 of revenue, Delta's spending $1.52. To drive $1 of revenue, Southwest is spending 60 cents. Right? So the one thing that is helping Southwest is the productivity. And you see that in their ROIC, that they actually have a slightly better ROIC than Delta. Okay. So that's why it kind of closes some of this gap in EV to revenue, but Delta's getting higher EV to revenue because of that giant margin. American is between the two, 0.67 versus 0.46. Why are they trading at a premium? 8% margin pre-tax, 5.7% Southwest. They're making more every time they sell a ticket. 6% after tax when they sell a ticket, 4% pre-tax or after tax when Southwest sells a ticket. But American spends more, $1.05 to generate $1 revenue, and Southwest 60 cents to generate $1 revenue. So again, Southwest gets a better return, 7% versus 6% because of that. But American still gets better EV to revenue because of this higher margin. It's being somewhat offset by the worsening productivity. Could be much better if their productivity was high. Pharma. When J&J sells $1, it adds the $4. $1 of revenue is $4 of enterprise value. Merck, $1 revenue, $5 of enterprise value. Why? Merck has a higher margin, 43% pre-tax versus 33% pre-tax for J&J. After tax, 37% versus 27.5%. Okay. The one thing, and this is just a quirk right now, Merck's productivity is distorted. Just weird data that's coming in. So I don't think that's truly representative of their long-term invested capital. But basically, why is Merck trading at a higher operating margin? It's the EV to revenue. And by the way, every now and then you're just going to get a wacky piece of data. These academic formulas, you know, you're going to get some noise every now and then. You've got to deal with it. So just be aware of that. Right? Why is Lilly trading at the highest EV to revenue? Number one, they don't have the highest margin. Pre-tax margin 38 versus 43, but they're higher in J&J. After-tax margin 33 versus 27.5. You'd expect that to have a higher EV to revenue. Why is it so much higher? They don't have the highest ROIC because their productivity is worse than J&J, 1.32 versus 0.66. But why is this more than double? The other factor, remember driving margin EV to revenue, margin times EV to EBIT, it's the growth. Is that they're growing this high margin at a high rate that makes their sales more valuable. So the other thing driving Lilly is the 6% G. It's helping their EV to revenue as well as the high margin. That one's a little bit more complicated. All right, Meta versus Microsoft. Batter up. Somebody tell me. $6.8 at Meta, 10.7 EV to revenue Microsoft. Why is Microsoft at a premium to Meta for EV to revenue? Lucas?
I'll take a stab at it. So they have a higher operating margin of 43.8%. They also have better productivity as far as the dollars that it takes to drive the sales.
Who's got the better productivity?
Microsoft.
Okay.
So they have 80 cents as opposed to the $1.08 from Meta.
Okay.
They're also growing at a faster rate. Microsoft's got 7.2 versus Meta 6.6. And then I'm forgetting now, does the spread affect that EV over revenue or not really?
Yeah, I mean, to some degree, if the cost of capitals are similar, it won't affect it, but there's a big difference in cost of capital. That would apply this as well. Probably not a big difference here, the 0.5%. So I think, as you just said, all three are kind of favorable to Microsoft, which is why EV to revenue is high. This one's pretty clean. Marcos, I saw your hand up. Why don't you do Meta against Alphabet?
So Meta against Alphabet, if you look at their operating margin, Meta's operating margin is higher than Alphabet's, but looking at their estimated long-term growth, Meta does have a higher percentage in long-term growth than Alphabet, 6.6 to about 5.8. Also, their tax rate is slightly higher, but it probably doesn't affect the long-term actual earnings to revenue ratio as much. Also, their capital, they're working at their WACs are about the same. It's not wouldn't really affect it much, but the spread is slightly higher for Alphabet, but I'm not sure if that affects it either.
Okay. So again, summarizing, even though Alphabet has a slightly lower operating margin, 35 versus 41, and an after-tax margin of 31 versus 34, Alphabet kind of makes up for the lower margin with the better productivity, 0.7 versus 1.08. Okay, so that kind of catches them up closer to 5.83 versus 6.83. But Alphabet also lacks the growth, as you pointed out. Alphabet's growing at 5.76, Meta's growing at 6.6. So the slightly higher growth, the slightly higher margin is why Meta's trading at a higher EV to revenue. Which, do you notice these multiples? Notice these multiples. Why are people paying so much more for revenue in the pharmaceutical industry? Why are people paying so much more for EBIT in the pharmaceutical industry than the airlines?
Operating margins in the tech industry are like 7, 8 times higher than in the airline industry.
So one difference is the margins, but what else?
Higher growth at bigger spreads or real spreads.
High growth at high spread, a lot of value, high multiple. Growth at negative spread, terrible multiples. This is just key value drivers played out in the real world. That's what the DCS are eventually going to tell you. This is just a shortcut. All right, questions? And we could show Verizon. I think you guys are getting this. why is Verizon trading at the highest EV to revenue of the three companies? They have the highest margin. Everything else is very similar. Although Verizon does spend more to get that margin, which is kind of hurting them, but highest margin, and you can call it a little bit higher growth, but that's why they're trading at a higher EV to revenue, 251 versus 2.3. But I want to get to how we build these, so you can actually do your analysis and do your homework for next week, right? So what you're going to be doing is I'm going to give you data. So you create three companies, basically put them into this format, and then you analyze them, premium or discount, one company against the other two. For PE, for EV to EBIT, EV to revenue, that's going to be your homework assignment for next week. Okay. So what I did is I posted earlier tonight in Elms. So we'll do this together. The first one in class. Under the files folder, under week 5, I did a folder called multiples in class. Okay. So the companies that I put in here are Costco, Target, and Walmart. These are all the screenshots and analyst reports that you need to basically do this exercise, right? And I put in here in the files folder a file called multiples homework. And this is going to be your homework assignment, doing with what we're about to do for Estee Lauder, Procter & Gamble, and who's RKT? Ricketts. Okay. So those are going to be, this is your homework files. That's actually loaded in the assignment, but that's actually where the base data is. Okay. So what I'm going to do, and because I'm going to be jumping around a lot, I'm going to share my entire desktop. A lot of stuff going on. All right. So we're going to start with multiples in class. These files, right? Which I actually have in this folder on my desktop. Okay. So this is, oh, we're going to upload that file. Let me upload that file. So I'm going to give you a blank version. Oh, it is already up there. Multiples assignment in class. It's already there. That's like the blank version of the file with no data in it for Costco, Walmart, and Target. And you'll use this file, just change the names for Procter & Gamble, Estee Lauder, and Ricketts, right? So I'm going to open up that Excel file. All right, so starting, there's 2 tabs, PE, EV to EBIT. Start out with PE, Costco. You'll get the data from their EEO screen. All right, first thing you're going to need is the expected net income for Costco, and we're going to use the second forward year. Same as before. So second forward year, count the columns, 1, 2, expected net income, 7906. Okay. I then need an expected return on equity. This is a remember we're doing the key value drivers equation, which is a perpetuity. So what I need is a perpetuity return on equity. Like, what is the long-term return on equity? Not what is the second year's return on equity? So down here, the analysts actually forecast the next 4 years. So last year, Costco's actual return on equity, 27.5%, 29, 29, 27, 25. Costco's been pretty consistent over time. So I think somewhere between 25 and 26 might be reasonable. So I'm going to use 26 for their long-term cost of equity. Okay. This one's a little more subjective, but the idea is I need a long-term cost of equity. Next, I need their cost of equity today, or sorry, return equity. That's off the WACC. Costco WACC today. Cost of equity 9.7%. Right there. So 9.7%. What is their PE second forward year today? Okay. Today, PE second forward year, 46.18. So process, put in the income, put in the ROE, put in the cost of equity, put in the actual PE that we observe in the marketplace today, solve for the growth, kind of like we did in our DCF. Okay, so tools, goal seek. So set cell PE, calculate PE in B9 to the PE I observe in the marketplace today, 46.18, by changing the growth rate, which is B3. So basically today, the market's using about an 8.22% growth in net income to justify that PE given that spread. I'm going to do the same thing for Walmart. So Walmart today, EEO. And so the reason
Professor, it looks like there's a question.
Go ahead. Lucas.
Lucas.
Thank
Thanks,
you.
Sarah. Professor, can you just show where to find the PE again? I missed that.
I'm going to do that for Walmart. This is the Walmart EEO.
Okay.
And by the way, the reason I'm using these screenshots from today, not the ones we did 2 weeks ago, or last week, whatever it was, is because the price has changed. So these are literally screenshots from today. You want to do them all at the same time. You have your data from, be consistent. All right. So right now, net income from Walmart next year, second forward year, 21,591 right there. So 21,591. Right. Return on equities for Walmart right here. Last year, 19%, then 22, 22 and a half, 22, 21. So 21 to 22, these 21 and a half. Right. These are fairly consistent earners. And then today, their cost of equity off the WACC screen, Walmart WACC. Cost of equity is 8%. Okay. So 8% cost of equity. And the PE, which was your question, you can see down here. Down here, this is the EEO, same as what we were doing. We did our DCF. Second forward year, 1, 2. So it's this column. PE, 25.22, right there. So 25.22. So then we're just going to goal seek, or we could iterate. So I can start putting like 3, 4, 4, not 48. Or I could just goal seek, which is just faster than iterating. Goal seek, set cell, calculated PE to the observed PE, 25.22, by changing the G, and Walmart's G, 4.95. And then we do target. Same thing. So target EEO. Right. Second forward year net income, 4704. Return on equity last year, 34, 29, 29, 30, 27. I don't know, he's like 28. Sorry, 28. Okay. There's a little bit more of an art than a science. I'm not just averaging. I'm trying to think about what is a reasonable long-term number using the next 4 years as a proxy. And then cost of equity for target is on the WACC. Today, 10.7. And their second forward year PE at target, 12.97 right down there. So for Target, if I goal seek their growth based on those numbers, $12.97 by changing the G. Okay. So that would be the data for Costco, Walmart, and Target. I went through that relatively quickly, but questions where I got anything, why I did what I did, how I did it. Hopefully I was mostly able to see what I did.
I have a quick question for you.
Oh.
I get why you're doing goal seek to find out what the market's doing, but wouldn't you want to set the G?
Well, we talked about this when we put together a DCF model, potentially. But the problem is, and I'll show it to you here. If I made Costco's ROE 30%, watch what happens to the PE. 46 to 49. If I make Costco's G 9%, watch what happens to the PE. The challenge is slight changes in G can have dramatic impacts on valuation, whether you're doing DCF or whether you're doing multiples. That's why you want companies to be in stable states. Well, that's ideal. Well, Costco, Walmart, and Target are still expected to be in growth mode. So trying to figure out what that growth is, and I say we can't do it that way, but slight nuances in growth have big differences in value. So an easier approach is the spreads are more predictable. So if the spreads are more predictable and tend to be more constant, then basically we back in, if values, growth, and spread, if we know the spreads, solve for the growth. What you're suggesting is if we know the growth, we can solve for the spread. I'm not saying we can't do it that way, but it makes it a little bit more challenging because of the idea that growth distorts things so much.
Sorry, I guess my question was, wouldn't you, like, after you know the spreads, like, wouldn't you want to solve for growth to get your value of what you think the PA should be?
Well, right now, think of this as like the as is. It's not the target. This is like the as is. We're valuing these companies based on their stock prices today. So this is not an opinion. It's just we're backing into the current stock prices. So this is an as is version for multiples.
Gotcha, that makes sense.
But I will tell you, hint, hint to, for example, the Ford team, when you're doing your multiples in 2 weeks, every now and then you have to go the other way. Like when your spread doesn't make sense in the next few years, you might actually have to create a growth, forecast a growth that creates a spread. Because the spread that you're going to create in the next 4 years may not be reflective of the long term. But that's for next week. You're not going to have that problem with this week's assignment. Other questions about the PE? All right, let's put together the enterprise value to EBIT multiples. So this down here is the EV to EBIT formula, okay, that was derived in the lecture notes from the book. These are the 4 things we need: G, tax rate, ROIC, WACC, right? And then these are the observed enterprise value multiples from the EEO. So since I'm on the EEO, I'm going to start with Costco's EV to revenue. So Costco. All right, second forward year, EV to revenue, 1.32. EV to revenue, EV to sales, basically same thing, 0.32. EV to EBIT, second forward year, 35.12 today. Okay. Tax rate. We can get that off of the company guidance screen. So for Costco, the guidance, same as our DCF, 26%. We'd actually done that. We did our modeling last week. WAC, today's WAC for Costco, 9.6%. So cost of equity on the previous screen, WAC on this screen, 9.6. Type tonight. All right. I'm going to come back to the ROICs. I'm just going to put these in first for the companies. So for Walmart, their WAC today was 7.4. %. They're off their EEO. Their EV to revenue today at Walmart is 0.86. Their EV to EBIT today is for second forward year 18.95. And we'll quickly do their tax rate from Walmart's guidance was 25.5 in the out years. 25.5. All right. And then for Target, their second forward year EV to revenue is 0.71. And second forward year EV to EBIT is 12.15. And if we remember, Target didn't give us guidance on tax rate when we looked at Target a couple weeks ago. So we said if we don't have guidance, we used the analyst as a proxy. We said use JP Morgan. So if you remember, we looked up the tax rate expectation for JP Morgan. Search, find this way. When we did Target, same as the DCF, and I believe we used 22% in our modeling. Same here, same tax rate as the DCF, 22. So no guidance, use analysts. Or come up with your own estimate, but you got to have something for the tax rate. Okay. And then today the WAC for Target was 9.3. So before I go further, those 12 numbers, does everybody know where I got them? You following along, putting them in yourself? Questions about any of that? All right. So this one becomes a little more challenging because the analysts don't directly forecast ROIC, non-Bloomberg, non the consensus estimates. So we need a forecast, which is the perpetuity ROIC for the company. Not a 1-year forecast, not even a 3-year forecast, a perpetuity. It's kind of like what we're trying to do here with the ROE. Okay. So I'm going to give you 3 ways to answer this question. And you're going to have to decide when you do a company, which one's the best. Ideally, when you do your as is DCF, which we did for Costco this week, this continuing value ROIC is that number. So ideally, if you did a DCF as is, your essentially perpetuity ROIC, you've kind of estimated. And in our modeling for the homework assignment we just did for Costco, 31%. That would be the perpetuity ROIC. For Walmart, we did an enterprise DCF. And we did that enterprise DCF for Walmart. We came up with 14.4%. And for Target, when we did our as is, we came up with an ROIC and perpetuity of 14.4. That was Target. Should be the same. Walmart. The right company here. No, that was Target. Target was 14.4. Got the wrong file name here. What was Walmart? So unfortunately, I don't know what I did. Did I overwrite that file? %. All right. So that's the cleanest way to do it. Now, you may not have a enterprise DCF model when you put together these multiple spreadsheets. So method number 2, this is not ideal, but method number 2, you can go to the RV screen and look at the current spreads. Multiples. Here's the spread of Costco, Walmart, and Target last year. And so the question is, if these companies' future looks a lot like the present, then the ROICs today look a lot like the ROICs tomorrow. And so you can kind of use the current ROICs to infer your future ROICs. So if we didn't do an ROIC, if we didn't do a DCF, we said, okay, Costco, looks a lot similar. And the reason we know that is because of these ROEs. There's a relationship between return on equity and ROIC. And so basically, if these ROEs are pretty consistent in the mid-20s, that probably means whatever ROIC today, they're going to probably have something similar that's tomorrow. So if we didn't do a DCF, we could probably use 21% here, and that would probably be a reasonable proxy. Now, because we did a DCF, we're actually getting, I think, a better number, but if we didn't do a DCF, we could have put in 21. Tomorrow looks like today. That's less than ideal, and you can see the difference between doing a detailed DCF and kind of doing this kind of kludge process. But you may need to do the kludge process. Because what you're trying to put in here is a representative ROIC in the future. That's method number 2. Everybody with me on those 2 methods so far?
Can you repeat that last method one more time?
Which one? The last method?
Yeah.
So method number 1 is do an enterprise DCF as is valuation. That's your best option. Option 2, shortcut. Look at the current performance of the company, which is the RV screen, the spread screen. We did since EIC analysis. Think about that. Right now, Costco's spread 21.2 versus 9.56, about a 21% ROIC. You say, okay, they're making about a 21% ROIC. If I kind of look at the ROE, it's pretty consistent over time, which means the ROIC should be pretty consistent over time. So somewhere around 21 must be what the future ROIC looks like if the ROE is staying pretty flat. So today looks like tomorrow. There's no big differences with tomorrow versus today. So I'll just infer that the current approximates the future. Less than ideal, but it's a kludge that you can do as a shortcut. But notice that 21 is a lot lower than 35 or 31. You see the difference?
Yeah.
But I'm telling you, if you didn't get a DCF, which you're not going to have for Estee Lauder, this might be one of the methods that you'll need to use. Which leads to kind of the second version of that I'll call method number 3, is there's got to be a relationship between ROE and ROIC, right? Mathematically, ROIC times the leverage ratio equals ROE, right? So therefore, if the ROEs and ROICs are going to be correlated if the leverage of a company doesn't change. So basically, if the ROEs are inching up, your ROIC should be inching up. If your ROEs are inching down, your ROIC should be inching down. There should be a relationship between your ROIC and your ROE. Okay, because essentially, I'll do it over here. I'm shortcutting and I'm ignoring taxes for simplicity. But the general concept is, what is ROIC? It's profit divided by debt plus equity. And again, I'm oversimplifying, not worrying about non-operating items, right? And what is ROE? Profit divided by equity. Now, one's net income, one's NOPAT. As I said, I'm kind of simplifying here. But here's the idea. How do you get from ROIC to ROE? You multiply by debt plus equity. Divided by equity. The D plus E's cancel out and you're left with return on equity. So the point is that is leverage. So the idea is this relationship, ROIC to ROE, you take ROIC times the leverage ratio, you get your ROE. I'm oversimplifying, but that's the idea, that they should be correlated. So if this stays constant, your leverage ratio, then the ROIC and ROE should track up and down together. So the idea is, if you have an ROE, you can kind of infer an ROIC. If you have an ROIC, you can infer an ROE. All right, that gets more complicated. You won't have to do that this week, but we're gonna get some examples next week in class where you actually have to do this. Okay, and it'll make more sense when we're struggling through to explain that. For this assignment, you can use either one of the first 2 methods. All right, actually probably the first method, because you're not going to do enterprise as is valuations on those 3 companies. Once you put in all the data, then you analyze, or sorry, you solve for G's, and then you analyze. So going back here, we goal seek. So what is the G for Costco? Get rid of that. Okay. What is the G for Costco? Tools, goal seek, set sell, EV to EBIT, 235.12 by solving for G. For Walmart, goal seek, set sell to 18.95 by solving for G. And for Target, just to hit the delete button, tools, goal seek a second time, set sell to 18.95 by solving for G. Okay, and goal seek one last time, that to 12.15 by solving for G. All right, those are the 3 G's for the EV to EBIT multiple. Once we do that, we then explain the premiums or discounts. Why is Costco trading at a premium to Target and Walmart? Why is on both the PE as well as the EV to EBIT? Costco against Walmart, Costco against Target.
I can jump in here.
All right, do you have a file?
I do.
Why don't you throw it up, because I'm having trouble finding. I got like 10 different Excel versions open too.
All right, the first item we noted was just the growth rate, and we just looked at Costco versus Walmart.
Yeah.
The growth rate of 8.22 compared to the 4.95.
Yep.
Benefits Costco there. The spread right here is 16.3 for Costco, 13.5 for Walmart.
Okay.
Benefiting Costco, but the downside for Costco is it is a little bit riskier for the cost of equity there, but items 1 and 2 outweigh that.
Yeah, so the 46 PE versus the 25, great. And I like the way you laid it out. So that's a good start. You want to do target while you're here? And you guys
I don't, yeah.
Just kind of, without writing things down, somebody in the team to help as well.
Yeah, well, looking at the growth there, I didn't pull the differences, but for the sake of time, Costco wins in that category.
Okay, 4%.
The spread is 17.3 for Target, which is a little bit better than the 16.3 for Costco.
Okay. So why is Costco trading at such a high PE then?
The growth, projected growth.
8%. Because remember, 4 and 8 doesn't sound big, but when you compound, it's dramatic. So it's that very high growth at a high spread leads to high multiples. And what we know from key value drivers is when the spread gets high, changes in spread don't matter that much. When you get above 20, 30, 40%, the incremental differences are minute and spread driving value. Then growth is everything. Okay. So that's also playing out here. So high spread companies, it's all about the growth. Costco's the growth. How about, great job. Did you guys get to EV to EBIT?
We did.
All right. So how about Costco?
What's that?
Costco, Walmart.
Costco, Walmart, expected growth rate, same numbers there, benefiting Costco. Tax rate has little to no effect here. The spread for Costco is 21.5 versus Walmart's 7.6. Smaller margin would hurt Costco, but they're able to make up for that with the growth. And then the higher WACC is riskier for Costco, but again, they make up for that with the growth.
Yeah, but that's the point, that the WACC is hurting Costco's EV to EBIT, but not enough to offset that high growth, high spread. And make sure you use numbers when you write this up in your papers.
Yep.
Okay. So you're doing such a great job. You want to do the EV to sales for Costco, Walmart?
We did not get to EV to sales on that.
So why don't you leave it up? Somebody else, EV to sales, Costco, Walmart. Why is Costco getting more EV to sales?
I guess I can kind of chime in. I think you may have an idea. So even though Costco does have worse margins than Walmart, across the board with 3.8 to 4.5, 2.3.4, their productivity is significantly better, being at 0.3 to 0.23. When having that much larger productivity, given the the larger growth, and I guess significantly better spread, it justifies a lot bigger premium on their EV to sales.
Yeah, you said 0.3. I think it's 0.09. It might be.
Sorry, I meant to say 0.9. Yeah, apologies.
But that's okay. You had the right idea. But yeah, they're high, great productivity at Costco, giving them a high ROIC is what's making them more attractive from a sales standpoint, EV to sales. All right. Questions from anybody about any of this? Good job.
So what was the reason that even though I guess maybe share my screen real quick just to talk about it real quick. So was the reason that Walmart that Walmart almost trading at double the PE, was that just because even though Target had a better spread, so from this just spread alone, you'd think Walmart would be trading at a lower PE. Just, I mean, the growth rates, there is a 0.8% growth rate, but you wouldn't think that would justify almost
Go-
double the PE.
Go
Is
to
it just because?
sell, go to
is it just-
sell D5. Put it-
Okay.
Go to D5 and put in 8%. There you go.
Okay, so it's mainly because of that. Because what I thought it was because given they have a slightly higher growth rate and they have such a large net income, and usually when you're a bigger company, it's harder to grow that. It's harder to grow the income. I thought that was what justifying the bigger
Yeah.
thing. But you're saying
Remember,
it's mostly.
Go to C2,
Mhm.
make that $1.
Oh, right.
Remember that PE, any multiple, is a function of growth and spread. The actual dollar amount doesn't matter.
Hmm.
There's a sizing aspect to that, but we talked about, kind of size versus quality. The quality is really what the PE is about.
Okay.
So, yeah, it gets harder to grow when you're bigger. So that I don't doubt that. But why is Target trading at a discount to Walmart? You kind of said it, it's the risk. They get a much higher risk profile at Target, 10.7 cost of equity versus 8 at Walmart.
Yeah, because
And
if recession
Walmart
hits,
does have a little bit better
Yeah.
growth and a little bit
Yeah.
better growth at a high spread, but really it's all about the risk between the two.
Okay. Yeah, and we talked about that a bit ago, right?
But
During
this is-
the more cyclical, if they
Yeah.
get hit by inflation harder and stuff.
But I'll also point out, there's a reason why this is called advanced. Okay, not just the class. This is advanced analysis for what you're doing here. This is not run-of-the-mill multiple stuff that most finance class teach. This is fairly sophisticated. So there's a lot I'm throwing at you. So it's going to take a little time to absorb. So this week, like I said, you'll practice with 3 companies. Next week during class, we're going to practice more with some more nuanced stuff. But to get into the nuanced stuff, we kind of need to get this. This is probably the other second hardest part of the class after the conversion stuff you guys had to do. But regardless, you start to get a rhythm, start to see this, the more you practice.